Cuando creíamos que lo entendíamos todo y que nuestros modelos eran capaces de medir todas las posibles variables del riesgo, llegó la pandemia y el gran encierro del 2020 nos obligó a reexaminar nuestros modelos. Para entender su efecto, particularmente en el análisis de crédito, tenemos dos estupendos conferencistas con nosotros el día de hoy. Soy Gerardo Herrera, director de comunicación de Rismatics, y es para mí un gusto y un honor presentar a Edward Altman, profesor emérito de finanzas Max L. Heine de la Stern School of Business de la Universidad de Nueva York. Es director de investigación de mercados de crédito y deuda en el Centro Salomon de NYU. Anteriormente, fue el director del programa MBA de la célebre NYU. Desarrolló, entre muchos de sus logros, el C-Score. Junto con él, tenemos el gusto de tener a Gabriel Sabato, quien fue director de administración de riesgo de crédito del portafolio en Ulster Bank y director global de análisis de riesgo de crédito en ABN AMRO. Fue investigador invitado en la Escuela de Negocios Stern de la Universidad de Nueva York, donde desarrolló varios artículos académicos con el profesor Altman y con quien fundó hace unos años Wiser Funding. Es un gusto tener a todos ustedes con nosotros en esta keynote speech, COVID-19 and the Credit Cycle and the Fast-Changing World of Finance and Technology. Bienvenidos a la Risk Management and Trading Conference. Mr. Altman, Mr. Sabato, welcome to the Risk Management Trading Conference 2021. It's an honor for us to have you with us, and we are looking forward to watching your presentation.
Thank you very much, Enrique, Gerardo, Alan Baruch, and the rest of the wonderful team at Rismatics. It's my great pleasure and honor to be one of the keynote speakers today and to be associated again with Rismatics and this important banking and trading financial market conference. Our topic today will be mainly COVID-19 and the credit cycle, and also some new developments in banking and in non-banking credit markets, particularly dealing with the small and medium-sized firms. And my distinguished colleague, Gabriele Sabato, CEO of Wiser Funding Limited, will be working with you as well. Next slide, please. Whenever we talk about COVID-19 or any downturn, it's very important to understand where we were prior to the downturn and, of course, what happened the moment the downturn started and subsequent to that. So we were in a benign credit cycle through 2019 into the beginning of 2020. And I will define exactly what I mean by that. But even then, I was asking the question, were we vulnerable to a downturn, whatever the catalyst would be? Indeed, I was very concerned with the dramatic buildup in global and US corporate debt and whether or not a debt bubble was building, even back in 2019. I also was talking about the interesting phenomena of a triple B rating growth, and that is the investment grade new issue growth starting in 2005 and escalating dramatically. And finally, we began doing some new research on the topic of global zombies, and we will explain that as well. Then, of course, we're all familiar now with COVID-19 starting in March of 2020. The benign cycle ended, a recession began, and it's still with us today, despite the fact that many economies of the world are opening up and GDP is again growing quite well. However, back in March of 2020, we had a dramatic downturn in the global economy. But it was met very quickly by dramatic actions on the part of the central banks of the world, particularly the Federal Reserve of the US, and subsequent congressional actions in many countries to add stimuli to the economy. And it worked incredibly well. Maybe more than anyone had predicted. And there was a great market rebound and a beginning, but still not very robust real economy. So one question that we are going to pursue is, with this dramatic increase in central bank activity, stimulating the economy, lowering interest rates, purchasing bonds and loans in the secondary market, did this lead to unintended consequences? In other words, things that were perhaps not predicted as carefully as we are now seeing. We'll talk about defaults and bankruptcies, a subject that many of you know is close and dear to my heart, so to speak, because I've been studying this now for more than 50 years. And we'll also look at the recovery rate phenomena when there are defaults. And finally, we will examine where we are today and what is the outlook. Next slide, please. First, let's look at the global economy. The dramatic increase over the last 20 years or so in global debt. If you look on this chart, you'll see back in 1997, the four major categories of global debt are analyzed: non-financial corporate debt, government debt, financial sector debt, mainly banks, insurance companies, brokerage firms, and household debt. This is a standard way of categorizing debt. Well, that debt has exploded over the last 22 years. From back in 1997, we had total global debt of $70 trillion. You can see these numbers on the right-hand side. That number has increased dramatically. In 2020. Instead of 70, we are now at 282 trillion, 336% of global GDP. So for example, in 2020, compared to 2019, just 1 year, corporate debt increased from 74 trillion to 81 trillion, an increase in of about $7 or $8 trillion. Government debt increased in 1 year from 69 trillion to 82 trillion, and so on. The financial sector increasing as well, but as a percentage of GDP, the financial sector is not growing like the others. And that's mainly due to regulation, as many of you know. And household debt, while it hasn't been increasing too much, certain economies certainly have experienced that. The bottom line in all of this is an enormous increase in debt, and it's going to continue. Perhaps even more so in 2021 and 22. Some of you may have read that the European community is about to issue a dramatic increase in debt to fund the stimuli throughout the EU. The United States will have to issue a dramatic amount of debt to pay for the stimuli, and many other countries. You're more familiar with what's going on in Latin America, but I'm sure that's going to be the case throughout. Next slide, please. Now I'd like to show you that that debt increase, for example, even has been in the most risky sector, the so-called high-yield bond market or junk bond market, particularly in the United States and in Europe. So you notice that in 2020, we had $435 billion of new high-yield debt, double B, B, and triple C rated. That was more than 100 billion greater than any year before. And in 2021, already in the first quarter, and in fact, through June of this year, we are getting going at an even higher pace. Perhaps we will see $600 billion issued in the United States alone. And a lot of that is the most risky part of it, the triple C. Now, why in a pandemic, in a recession, do we find a very unusual situation of increased debt and increased risky debt? It's very simple. Interest rates are low, so companies are encouraged to issue debt, bonds. As long as they can earn more than the cost of debt, which is very low, they can add to their shareholders' wealth. But also investors are interested in the most risky debt in their search for yield, because interest rates are so low on traditional forms of financing. And so we can look forward to perhaps a record year in risky and in investment grade debt, adding to that debt picture I mentioned before. Next slide, please. This shows you what happened in 2020, and the big increases started in March of that year in both investment grade on the left and high yield on the right. Next slide. Now, when we experience this increase in debt, certain leverage ratios of companies also change, such as the debt to EBITDA ratio, that's the debt to cash flow of a company. For investment grade, it increased on the left-hand side to 3.5 times, and for high yield, 5.5 times as an average. And don't forget, whenever you talk about an average or a central tendency of a distribution, we know that about 50% of the observations are greater than that average. And even greater leverage on leverage buyouts. And now, of course, we have other types of new financing, such as SPACs and IPOs, and I'll get back to that phenomena soon. Next slide, please. Another increase we've noticed dramatically is the purchase price multiple. That is the enterprise value that is being paid on leverage transactions compared to the cash flow of the company, the EBITDA. In 2020, in the fourth quarter, it reached 12 times. For every $1 of cash flow, $12 is being bid on the company. And of course, these are companies that have cash flows. And when we deal with companies that do not have cash flows yet, that are positive, we have, of course, astronomical valuation multiples. Think back in 2007, the average was 9.9 times, and now we're at 12. Yes, a lot of these transactions are being financed with equity, maybe 30% of the capital structure, 35%. But still, 65 or 70% of a very high level of transaction price is a lot of debt. And this is adding to, and a lot of that debt is being used to pay dividends to shareholders, to return capital, and not for growth purposes. It's kind of unsettling, but it is the situation. Next slide, please. And this shows the debt to EBITDA ratio. As I said, in 2020, it reached around 6 times. And that's the highest level ever, except for 2007, when it was 6.2 in the United States and 6.6 in Europe. I don't know what it was in Mexico and Latin America, but I'm sure that they are seeing similar phenomena. Next slide, please. I'm going to skip this slide in the interest of time. Next slide, please. By the way, you will all have access to my PowerPoint presentation, to our PowerPoint. And so even if we skip some slides, you can look at it when you have time. Now I'd like to talk about how you know where we are in the credit cycle. And I look at 5 indicators to determine it. That happens to be my preference. Many of you who are practitioners in the credit world perhaps are looking at different indicators. The first one I look at is default rates and bankruptcy rates. The high yield bond default rate, it's an area I've studied very carefully, historically has around 3.3% per year. As of the end of April, the forecast for 2021 was about the same, 3.5. So we were kind of in an average. But let me tell you, since the 30th of April, the forecasts have come down dramatically. One rating agency in the United States is now predicting only a 1% default rate in 2021. That's Fitch. And I'm sure all the other forecasters, and we'll talk about that, are lowering their estimate. Recovery rates, loss given default. Many of the bankers know this is a major Basel criteria, was about average so far in 2020. And in 2021, it's way above average, maybe 80%, of course, on very small numbers of defaults so far. So this is either average or benign as an indicator. The required return of investors, so-called risk premium over the government rate, dropped to about 2.6% at the end of April, compared to a historic average of 5.6%. So investors are only asking a very small premium because they are so interested in getting higher yield no matter what the premium is. Again, this is an indication of a benign credit cycle. Distress ratio. This is a term that I developed back around 1990, and this shows the percent of high yield bonds that are trading at more than 10% above the risk-free rate. That number at the end of April was 4%, and today, I just saw the latest data, 2.6%. Only a little over 2% of high yield bonds are trading at distress levels, compared to a historic average of 10%. Again, a benign factor. And liquidity going through the roof. There's so much liquidity out there following the debt of companies and the equity of companies, hopefully very soon. So we have ample supply, again, a benign credit cycle. Conclusion, we are clearly back in a benign cycle and are likely to stay here for the rest of 2021. It's beyond 2021 that I'm mainly concerned with, not with the remaining months. Next slide, please. This shows you that risk premium spread for the option adjusted spread, it's around 3.3%. The yield to maturity spread was around 2.6, compared to a historic average of around 5.5. So look, investors are really asking for a very small premium, similar to the height of debt situation back in the past, and perhaps will reach the lowest level ever. Next slide, please. This is an important slide because it shows, the blue line shows how much corporate debt there is relative to GDP. And the red dotted line shows default rates. Notice that we've had 3 peaks in debt to GDP of companies, followed very closely every time by a surge, a big increase in default rates to above 10% in 1 or 2 years, 1991, 01, 02, and 08, 09. Fast forward to the right-hand side and you see the current situation. A dramatic increase in corporate debt as a percentage of GDP, way more than ever before. And there was a Wall Street Journal article just yesterday that highlighted this, but I've been talking about this now for a year and a half. And there was a surge in defaults, but not as much as we have experienced in the past in downturns. What happened in 2020 was remarkable. There was a big increase in corporate defaults in the United States. Outside the United States, like in Europe and many other countries, governments, banks, regulators stepped in and said, we realize we're in a pandemic. We're going to support companies. They don't have to pay their interest. They don't have to pay their principal. We are suspending that. And this is continuing into 2021. It was just announced again with the Wall Street Journal article yesterday that this is likely to continue for the rest of 2021. But ladies and gentlemen, this moratorium will come back to haunt us after the moratorium is lifted. And a lot of companies, maybe some of them zombies, will no longer be able to exist, especially if interest rates move up at the same time that the central banks are fighting inflation, which is another potential risk factor. And we find that there is no longer this support system for companies to pay back their liabilities. Banks all over the world are going to have to deal with this reality. When they give up the moratorium, what will be their non-performing loan situation? It could be ugly. Next slide, please. This shows, in fact, that most of the time you have an increase in default rates. Those are the black solid line. They closely follow recessions, and that's where we are today. But the default rate is artificially being kept low by governments, by banks, by regulators, and also with this low interest rate environment. Yes, a lot of people say, don't worry about defaults because the amount of debt that's been issued has been so low, the interest rate, that companies easily can afford it. That's true. But some companies cannot if they're not even making any profits, or if they're making profits and the interest rates go up, we could find some problems. I'm not saying that we will have it immediately, maybe not even in 2022, but I'm very concerned about what happens down the line. I'll go back to that. Next slide, please. Forecasts. I'm going to skip over the next couple of slides and get to the actual forecast, but I use three techniques very quickly. Mortality rate, some of you may know that. It's like an actuarial technique. I also use, next slide, please, current, next slide, please. This shows you the mortality rate and the mortality loss. So I can tell you, given a certain rating at birth, what's the likely probability of default 1 to 10 years later? You can look at these matrices at your leisure to plug in the level of debt issued, that's on the left-hand side, and the likely outcome over normal credit cycles. Next slide shows you the same data, only inputting recoveries, and so we get a loss rate. Next slide, please. This shows you a regression of today's yield spread relative to the default rate 1 year from now. Very high correlation, very useful to use it when yield spreads are very low, as they are now. The default rate at the end of this year will clearly be also low. Next slide shows you that same relationship, but now it's the distress ratio. That number now is only 2.6%, and that ratio is also predicting a very low default rate in 2021. So, good news, low defaults in 2021. Bad news, a lot of them are going to be delayed. Next slide, please. This shows 12 institutional and myself forecasters of default rates and how we've changed. At the end of 2020, the default rate was 6.7%. At the beginning of 2021, the forecast was a little over 5%. And today, the forecast is under 3%. And some, as I said, are even thinking it could be only 1%. a dramatic change representing dramatic liquidity, increased economic activity in many large countries like the United States and China, but also dramatic increases in debt. Next slide. I'm going to skip very quickly, but 2020 had a record amount of large company bankruptcies in the United States. 180 companies with more than 100 million in liabilities and 60 companies with more than $1 billion in liabilities, by far the highest year ever. So while the default rate overall was not the highest ever, the number of large bankruptcies was the highest ever. However, the number of small company bankruptcies that were supported in this pandemic actually dropped dramatically in 2020, and personal bankruptcies were down. That will all be, I believe, reversed once that moratorium and support system leaves, as it surely will, especially with inflation on the horizon, if not here already. Next slide, please. We can talk about what's happened in 2021. It's way down from 2020, but again, reflecting this artificially successful, but artificially prompted situation. I must say that the central banks must be very, very happy with the success of their policies. But now they are assessing very carefully when to stop this support and fight inflation. And I think this is going to be a tug of war that we're going to see play out over the next few months fairly dramatically. Next slide. This shows recovery rates. This is a complex slide, but it shows the relationship between default rates and recovery rates. For those of you who follow this market, you know that when you have a lot of defaults, like 7, 8, 9, 10% for high yield bonds in 1 year, you have low recoveries. And vice versa, on the upper left-hand side, you have high recoveries with low default rates. In 2020, if we have a 1, 2, or 3% default rate, recovery rates will be quite high. I would like to boldly, so to speak, predict that this could be the highest year ever for recovery rates on defaulted bonds. I'm not talking about loans, because the loans are much different in a sense that they're the ones that are being supported by the governments, and those loan defaults will be very low this year. Next slide. Okay, let me go quickly and mention that this explosion in debt is perhaps most seen among the BBB rated bonds. This slide shows you from 2005 to 2021. It has increased in the United States from 500 billion to 4 trillion. A huge increase in this lowest of the investment grade category. I'm convinced in the United States, this is the rating of choice. This is the area that companies are taking advantage of this incredible liquidity along with the high yield bonds. But the question I posed in 2019 and again in early 2020, how many of these BBBs would be downgraded to non-investment grade, so-called fallen angels? And so I ran my Z-score model that many of you know I developed more than 50 years ago, and it's still surprisingly so very, very useful and used by many practitioners as well as academics. Next slide, please. This shows you the breakdown by rating category in the United States, and BBBs far outdistancing all other rating categories. Next slide, please. And here we see the original Z-score model, which some of you are familiar with, I would guess, and hopefully others will become. And Next slide shows the bond rating equivalent of those Z-scores. Next slide, please, Axel. And you can see the bond rating equivalent in 2020 for a triple B rated bond was a Z-score of 3. And a D, the default, has dropped to around 0 or below 0. So now my major cutoff score is around 0. And I'll get back to that with the zombie idea. Let us now, one more slide, next 3 more slides from now, Axel. 3 more slides. 1, 2, 3. This slide shows that I predicted something like 30% of triple Bs could be downgraded over the next 2 to 3 years. This was back in 2019. It hasn't happened, mainly because I believe a lot of these companies that were vulnerable were being supported also by governments and by central banks. But here's a list of some well-known companies that were downgraded during the pandemic. Ford Motor Company, Occidental Petroleum, Continental Resources, Delta Airlines, Macy's, Marks and Spencer, Pemex, that you all know very well, Rolls-Royce, and a bunch of others. Every one of them had a Z-score below triple B bond rating equivalent, which I believe you can use to determine which ones are most vulnerable to downgrades. Finally, let me talk about zombies. Next slide, please. Okay, keep going, Axel. I want to skip over a few slides. Keep going. Okay, 1 slide back, please. What is a zombie? A zombie is a company that is artificially being kept alive, either by subsidized interest rates, by moratoriums on their debt, by government regulation supporting companies. But these companies all display unmistakable signs of high distress and insolvency. Is that important? In other words, how important is it if we observe an increase in the number of zombies in the world? Well, economists would argue it's very important because it's a misallocation of resources directed toward failing companies. Positive spin on it would be because they are important companies, some of them, and it keeps the unemployment rate from increasing very much. I believe also it's one of the reasons why we observed for many years a lot of deflation, because these companies lower their, and so do their competitors. How best to measure them? Let me tell you what we are doing very briefly. Next slide, please. This shows you one estimate of zombies in the United States of 20% of listed companies. I think but this is based on simply companies where their earnings are not sufficient to cover their interest. I don't think that's a good definition. It's too liberal. Instead, next slide, please. If you looked at the United States, if you look at a 3-year moving average of cash flow to interest, you find that somewhere between 15 and 20% of companies have less than an interest coverage or a cash flow coverage of 1. Let me skip 2 more slides, Axel. Yeah. This slide shows you our current thinking on how you measure zombies. We look at 3-year moving averages of both interest coverage and Z-scores, less than 0. In other words, where companies display unmistakable signs of impending default, but they don't default. Where their interest coverage is less than 1, but they don't default. And in the United States, that number is between 8 and 10% of listed companies, probably much higher for non-listed companies, private companies. I'm going to skip a bunch of slides and go to Mexico. So keep going. I'll tell you when to stop. Good. Go back 1. Yeah. Now, Mexico, I was really surprised and impressed. It seemed that Mexico only had, in 2019, it's higher in 2020, maybe 2 to 3% in 2020, not shown on here, and only 1% of companies, but there was only 91 listed companies that we had data on. Now, the listed companies are obviously the largest and most successful companies in Mexico. So what we need and what we're looking for now is a large database of non-listed private companies. And then we're going to take a look at how many zombies are being there. I'm sure it's going to be higher than 1%. Still, Mexico is far lower than many other countries. And perhaps you can help answer me that question. Finally, let me now introduce my co-speaker now. If you go to the next slide, keep going. Okay, go back 2 slides. One more. Whoops. Okay, 1 slide more. Thank you. Okay, let me now introduce my colleague, Gabriele Sabato. I'm really delighted to have him speak with me, and he's also giving an educational workshop on small and medium-sized firms on the 24th of June for many of you in the conference. Gabriele is CEO of Wiser Funding. He's co-founder and chairman. I'm the co-founder and chairman with him. And our firm is oriented more toward, as he's going to talk to you, small and medium-sized firm analytics. Gabriele, over to you to introduce the topic, especially the trend in banking that we see.
Yeah, thank you so much, Ed. It's truly an honor to be having this short slot with you in your keynote. So thank you so much for that. And let me just very quickly tell you why I think this discussion is relevant in everything that you've been talking about for this last 30 minutes. Obviously, you've shown a massive amount in debt. You have also clearly told all of us that this debt for the moment is holding up, but there are a lot of uncertainties around where we are going. And obviously, we'll need to see what's going to happen in 2022. And I guess the last thing, very important, you mentioned there, mind the zombies. So these companies that are artificially kept alive and are surviving because of the large amount of debt out there, because of the government support. And obviously, when this will gradually fade away, we'll need to see what's going to happen. So everything you have told us so far is clearly indicating at an increased risk in the system, okay? And so we're seeing a lot of the banks that have been providing large amount of debt so far, starting to think about if they want to remain in the SME space. Why? Because SMEs, obviously, we all know, are generally riskier. And so to be in that space so far where there were government guarantees in many countries across the world made a lot of sense. But obviously the question is what's going to happen next? I mean, many of you may have seen HSBC deciding to withdraw from the US market, retail and obviously SME lending. So it may be just the start of something. What we have done with Ed, obviously I was fortunate enough to be a visiting scholar with him many years ago, and since 2003 we started to focus our research on small and medium-sized firms, how to assess their credit risk. Obviously, Ed has been one of the pioneers of the credit scoring, the Z-score model, as he just mentioned. Is something that goes still very well and widely used across the world for large corporates. So our idea 4 years ago was to create something that could be used to assess the credit risk of SMEs. And that is basically what we've done with Wiser Funding, putting together almost the perfect mix of academic research and latest technologies to create value and help everyone, for example, in a moment like this, obviously, to better navigate the macroeconomic situation. And so where we are today, if we move to the next slide, is basically we have created a company that can truly bridge a gap between the credit reference agencies that traditionally more focused on consumers and the large rating agencies, traditionally more focused on large corporates. A company that can bridge that gap and help a lot of, obviously, the financial industry to assess, to understand better the SME world. Very important to drive forward the recovery across the world. SMEs will be absolutely key. And so being able to understand and separate zombies from, going concern, I think will be a key competitive advantage. And if we move to the next slide, in general, what everyone needs and wants is 3 main objectives. Taking better decisions, obviously from a credit perspective, doing in a faster way. So in, obviously in a digital world, all decisions need to be taken very quickly and ultimately improve the customer journey. That's where, we try to add most of the value. Digital world, well, obviously coming out of a year like this, everything has accelerated. We have seen it because of the digitalization in almost every aspect of our life. Being able to consume a large amount of data in a very small period of time is now paramount in everything, including obviously the financial industry. And having said this, if we move to the next slide, I guess really what we're trying to do is to create a company that can help everyone globally. And to do that, you need a platform. So I mentioned at the beginning, the right mix. So all the models that we have developed are stored on the cloud. This is a cloud-based solution so that everyone can access it across the world. And, obviously in a conference in Mexico, I'm delighted to say that just a month ago, we have been chosen together with another 4 firms in a very important accelerator, the Monterrey Digital Hub, there in Mexico. So very soon we'll be customizing and tailoring our models and our proposition to the Mexican market. And I close with the next slide, just saying why we believe Mexico, Latin America are key markets. Well, obviously because, as you can see, hopefully on this slide, the level of data available, for example, open banking, for example, all the data about company, financial disclosure, it's very high. It's very high. It's at the level almost of the United Kingdom, Australia, India. So definitely markets where the more data we can consume, the better risk assessment we can provide. And that is important to drive forward the recovery. And on this note, again, let me thank you so much, Ed, for this little slot and let you conclude your keynote speech. Thank you.
Thank you, Gabriele. I should indicate that Gabriele has been a real pioneer himself in taking some of my basic fundamental ideas on credit scoring, adding artificial intelligence, data gathering, cloud-based solutions, and macroeconomic factors. Altogether, we have begun, and also with great success in a number of countries, including all of Europe, India, Asia, and Africa, and now we're targeting Latin America as well, to bring this cloud-based solutions on a more global level. Let me conclude by giving you some observations about the market, some of which I've mentioned before. Debt issuance is continuing to accelerate, both for the corporate and government levels at record levels. There was record amounts of investment grade and non-investment grade corporate issues, which caused very dramatically the corporate bond prices to rebound and saved investors, in fact, made possible investors to make large profits in both equities and debt markets. This unprecedented early support from the US Central Bank and Congress continues with massive support in 2021. Successful, wildly successful, but with unintended consequences. And I've been saying this now, maybe I'm more of a, somewhat of a pessimist, but whenever you have great things happen, you also have the potential for the consequences. So let's be prepared. And though what I mean by prepared is, my plea is that companies that have been seduced and taken great advantage of this low interest rate environment to raise leverage, to take advantage of potential profits now escalating on a low interest rate environment. Well, those companies, in my opinion, should start issuing equity when the stock market remains high, before it is too late. Because once things turn around, if we have another downturn, whether it be in economic terms or in financial market terms, it's too late to raise equity, or at least too late for all but the best firms. So my plea is enormous new business formation, which is happening. Be careful. There could be lots of defaults with new business formation, and to issue equity whenever possible. Finally, let's watch this global zombie trend. Now, while countries like Mexico do not appear to have too much in the way of zombies at this point, countries like the United States, France, in Europe, many other countries of the world are experiencing big jumps in zombieism. The world cannot support zombies forever. And we found that out in governments. I'll be talking about sovereign risk, by the way, in my seminar coming up on June 23rd, when I talk about the evolution of Z-scores. So let me conclude by thanking you for your patience, thanking Gabriele for his participation. And now I'll turn it over to Herrera Villanueva Gerardo to lead the Q&A discussion. Welcome, Gerardo.
Thank you very much, Mr. Altman. Well, Mr. Altman, Mr. Gabriele, very insightful presentation, very interesting, especially for a region like Latin America that has been hounded by credit crisis in the past, by high indebtedness in the past, and the region is characterized by economies fully carried or strongly carried by the effort and impetus of small and medium companies, that those companies that people rarely talk about, that credit agencies rarely pay attention to. So right. Your conversation has been very interesting, gives us light of trends to come. I think we have a few questions from the audience, very interesting questions. I guess the first question to put forward, Mr. Altman, could be, what is the increase? Well, what's the increase in bankruptcies in 2020 concentrated in certain industrial sectors, or was it found across the board?
Yes, certainly in 2020, we had those sectors that are most sensitive to the pandemic have an increased bankruptcies, like restaurants, like travel related, entertainment related, but also certain sectors that were already on the verge of problems, like oil and gas industry, energy industry. Now, things have turned around dramatically, but you remember, Gerardo, that in fact, there was a couple of days when the price of oil was negative, and you can't make any profits if you're an oil and gas company, if the cost of your output is zero or negative. But most of the time in 2020, it was oil and gas, restaurants, travel and leisure, etc., and also some healthcare companies. Now, the future, we think there's going to be a big increase in bankruptcies and defaults in the commercial real estate area, shopping malls, office buildings. We already saw a giant company go bankrupt in the United States just a few days ago. Wow, you know, that was very bad news for the investors in that company. It is an indication of a very stressed sector coming out of the pandemic. I also believe that there will be continuing problems in certain industries that do not recover as quickly as others, like the cruise lines area. Even air travel, which is seeing a big boom, is still way below what it was before the pandemic. So yes, certain sectors certainly had increased bankruptcies. And as you pointed out, and as we did too, this was not the case as much in the small and medium-sized sector. But that's where we think could be the most stress going forward.
As a follow-up on that, Mr. Altman, do you think that the wave of bankruptcies has passed? In other words, have we seen the worst of this, or can we still have some volatility, some really bad times ahead?
Well, certainly 2021 will be a very low default period. All the indications are now it'll be way below average. That's true globally because of the supports that we talked about. There was an article again in the Wall Street Journal just a few days ago about European non-performing loans being way down, very, very low. But every banker knows that this is an artificial period. This is not something that will continue. And the most vulnerable companies are particularly the ones that are not as capitalized, do not have access to credit. And that will be the case going forward, probably starting in 2022. But I'm not sure when. That's an uncertainty, whether it will be mid-year, end of year, or whatever. But what I'm really concerned about is 2023 and 24 for a big increase, again, a surge, especially if we have high inflation, which I believe we will, and if interest rates need to be raised, you know, coincidental with that high inflation, which I think also will happen. And when that happens, the companies that have used low-cost debt capital will need to refinance or increase their debt to cover their shortfalls, but it'll be at higher interest rates. So yeah, short term looks good. Medium to long term, I'm quite concerned with.
In summary, will we see the great lockdown of 2020 as a kind of Darwinian event, one of those strong, the survival of the fittest?
I don't know about that. That's maybe too philosophical for me, but we certainly are going to see a lot of companies doing very well, especially in countries where the lockdowns are, gone essentially. I had dinner last night at a local restaurant out where I am now, and at least in the United States, the restaurants were packed. Nobody had masks on anymore. It almost seemed like normal times or boom times. I know that's not the case in many countries. Some Latin American countries have suffered, with the COVID because of removing the lockdowns too early or not having lockdowns. But I am concerned that, whether it'll be a next wave or other problems or just normal recessions, on top of this huge debt increase, we're going to see record amounts of defaults again, perhaps not until 2023 or 24, but we have to be on guard for this. And one way to be on guard for this is start issuing equity now. Don't wait.
You touched upon an issue that it's been largely discussed nowadays all over the world, inflation. Why is inflation such a concerning factor?
Well, I've been concerned with inflation, but let me just say first, I'm not an expert on inflation. And a lot of people who were predicting inflation in the past were really surprised that it has not happened for so many years, particularly in places like Europe. But what I observed was, first of all, a tremendous increase in individual savings. And that's unnatural. So they're going to start spending. Second, a big shortage of labor. What has happened in the United States anyway is that lots of individuals have left the labor force, at least in the traditional labor force. And so while the unemployment rate is dropping now below 6% in the US, still quite high historically, the amount of actual workers is insufficient in certain industries. So what will happen is the companies will have to pay higher salaries to attract whatever individuals they can. That's already happening. I have two nieces, 15 years old and 19 years old. They have so many offers to work now in the United States, mainly in restaurants or leisure industries. And they can say, okay, but who's paying more now? So we have this wage inflation starting. Supply chain problems. Lots of problems on supply chain for many, many reasons. I'm no expert on that, but I'm told that. And finally, commodity prices going through the roof. Mm-hmm. I don't see how we will have just temporary inflation, as some people are hoping. I mean, the central banks have all said, don't worry about inflation. It's only going to be temporary. I'm a skeptic. I think this is going to be with us for quite some time, not just a few months. I could be wrong. Again, mea culpa, I'm not an expert on inflation, but I don't know who is these days, to be honest with you.
Okay. Now that you mentioned commodities, we have certainly had our share of problems in Mexico. We have seen avocado sky high, like never before, for example.
Yes, I love avocado.
Okay, now let me turn to Gabriel. Gabriel, now that you touched upon the issue of small and medium companies, which is very important for Latin America and for the region in general, were small and medium companies more resilient during this crisis? What information or what judgment or appraisal do we have so far?
Yeah, thank you so much, Gerardo. That's a great question. I think it depends a little bit on the geographic area. Okay, so in Europe, we have seen that the smaller companies in general have been a little more resilient, just because the level of support that has been put in place for them has been kind of higher than the one offered to larger companies. And again, there are small differences across countries, but a lot of them have been able to survive longer, where they're also smaller. Their fixed costs are lower than larger companies, so it's easier to adapt, to cut costs more quickly. And that has been a reason for resilience. But let me also tell you that it's not enough. That's basically what Ed was saying before, because just cutting cost and surviving using debt makes you pretty much a zombie. And to really go back and use fully your resilience to start trading again, you also need to look at your business model and adapt it to the new normal. That's the way we all refer to it, right? So the new normal means having a potentially different business model, more digital proposition, and that is key. So resilience, if by resilience we mean survival, yes, but up to a certain point that will go on. To really be and show resilience, all these SMEs will need to finally review their business model and fully adapt to the new normal.
Okay. Looking forward, and now that you mentioned this model that you presented to us, how can artificial intelligence impact and help corporate credit analytics and small and medium credit analytics?
Yeah, again, another great question. Thanks, Gerardo. I guess, well, everywhere in the world, artificial intelligence now is a little bit of a buzzword. It's everywhere, right? And I mean, it can be used in so many different ways and can mean a lot of different things. I guess where it could really be useful, or at least that's the way we use it at Wiser Funding, is to actually transform data, help us to process a large amount of data in a small period of time. And that's the key. The world is getting now a huge hangover of data. Data is everywhere. On a daily basis, there are new data points coming out, transactional data, open banking data, financial data. It's truly hard to even, understand what is happening. But obviously, just data don't give you insights. And artificial intelligence is one of the ways that can help us, all of us, to process this very large amount of data and get very useful insights.
By the way, Gerardo, we found that the accuracy level of our credit scoring models, which were quite satisfactory using just financial data, were increased fairly dramatically when we added artificial intelligence techniques to process non-financial data and governance data of the company on top of the financial data. So it's like a sequential increase in information beyond the traditional credit scoring models that I've worked on for many years. But we could not have gone to a satisfactory level of accuracy for this more difficult SME space just with financial data. It's helpful, but we need more help. And I think we're making great strides in this area, and it's one of the great, I think, new areas in credit risk analysis that we'd like to emphasize to our audience.
So you're telling me, Mr. Altman, that in a way the model proved to be resilient and became more holistic?
Absolutely. And one other thing. When we were in the pandemic, and we still are, I guess, in many places, what we did with this modeling technique is stress the system. Certain companies, were more stressed than others from the pandemic, or will be more stressed than others during the next downturn, whatever the catalyst. And so with this technique, what you could do is do a pro forma analysis. How much of your sales will be impacted? How much of your cost of goods sold? What will be the impact of inflation or deflation? What will be the impact of your rising level of debt on your final credit score? So it's a combination of better data and understanding better, the kind of stress tests that I think can be done with a model in a very short period of time. We don't have to have teams of analysts pouring through the data. We can do it probably, within a few hours, if not a few days.
Okay. Well, we could stay here for another hour, but we have to wrap it up. Mr. Altman, Mr. Sabato, thank you very much for such an insightful presentation. And to you all that joined us in this COVID-19 and the credit cycle keynote speech, thank you. And looking forward to seeing you in the rest of the Risk Management and Trading Conference.